G'day, ladies and gentlemen. My name is Craig Cobb. I'm a trader of 20 years, and if you want to be a better trader, subscribe to this channel. I've got a whole series of videos here for you to go through to teach you what I use after 15 years full-time trading and 20 years in markets. So please do enjoy this course brought to you by BloFin. If you want to open an account with BloFin, which I recommend, use the link below. Okay. We're getting into the pointy end of this now for most of you. We're at the key, the bottom end of it. The most important part before you start raising orders, that is, and it's your money management. It really is the most important part. Too many people focus on the potential profits, and well, if you're going to do that, you're going to get wiped out. You're not going to get the results that you want if you're not first and foremost managing the capital that you have. There's so many reasons for us to do this, but this survival is the most important thing. You are going to make mistakes when you trade. And it's just part of learning anything. It's part of learning anything. So just know that if you manage your risk, you're going to stick around. You're going to work out how to get this right. And just like me, after fumbling around for 4.5 years, I finally got it together. The only reason I had any money left was because for the final account that I funded, I blew out two before, poor risk management, you put it together and it works. I'm not suggesting it's going to take you that long. Don't forget, when I started doing this 20 odd years ago, there wasn't even YouTube, mate. It was a much longer process. So you're in a good place right here. All right, so let's look at risk and money management because it is an incredibly important aspect to any trader's longevity in markets. Now, gamblers are going to focus on rewards and profitable traders are going to focus on risk. That is probably the best comparison I can possibly give. A lot of people say that they're trading, but really they're just gambling in a financial market of some kind. Someone who's a foreign exchange trader who has no idea what they're doing is effectively just having a punt. It's the same as going and having a punt on the sports bet or on the horses. For some of you, you're professional at that. For most of you, you're not. So the common questions are, where do I take my profits? When should I move my stop loss? And why do I take a 1-to-1 and not 4-to-1? These are your reward to risk principles, but it all goes around, first of all, risk. The questions are good to be having, but a plan in place is the only way you're really going to survive and move forward with any real purpose, structure, and longevity in this space, or anything for that matter in life. You've got to get a plan together and you've got to stick to it. Now, if your focus is like what mine is, which is on how much can I lose as opposed to how much can I make, you're going to be focused on keeping the money that you do have. And, it's like if you're someone who sells cars, you've got a car yard as a business, right? Well, the objective is to sell the cars that are within your lot. Well, you need cars to sell because that's your business, right? So if a car salesman's business are the cars, if they don't have cars in the lot, they've basically just got a lot. They've got nothing. They've got no business. Now, I'm going to relate that to trading. Without capital, you have nothing. Your cars in the lot, so to speak, is your trading capital. So you better make sure that you nurture that, look after that, and shift that risk into reward in a responsible way. Planning your trade and trading your plan is such an important part of this whole trading game. Now, some of the simple things to work out is how you're going to target things. Now, the first thing I want to say is that the minimum reward to risk ratio that you want is 1-to-1. This simply means that if I'm going to be risking $500 on a trade, if I was to get stopped out of the position, I lose $500. Well, then my minimum reward objective needs to be $500. If you can aim for higher targets as well, but let your trading decide what is going to be best for you. Of course, there's more than just 1-to-1. There's 2-to-1, there's 3-to-1, there's 4-to-1, there's more. There's scaling out and leaving runners. But as a minimum, if you're risking $500 to make 100, it's not going to take many trades. It's going to take 5 trades for you to get 1 loss back. And that's not stacking the odds in your favor. That's just a simple bit of math there. I'm sure you can get your head around. So stay patient. You have time. You need to build your understanding of markets and you need to have capital. So manage that risk and don't take targets that are too small because it will just stack the odds against you in a big way. A couple of things for you to notice and really consider is this. Every time that you raise an order or go into the market, you have a degree of risk. Okay, it doesn't matter how much you think it's going to go up. No one cares. And I mean that in the most sincere way. No one cares. The market doesn't care. The market doesn't care that you've got to pay your kids' school fees. The market doesn't care you've got no fuel for your car. The market doesn't care that you've got to pay your rent. You've got to care about the market. And in other chapters within this series, I've talked about that, about having a dance partner, working with the market as opposed to telling it what you want. It won't work. So again, coming into this, we've got to be understanding that every trade that we take is a level of risk. And the reason we risk our capital is for reward. You got to fully understand it means freedom in a way. And I know that might sound like a strange statement, but to understand risk means that you can control it. When you can control something, the fear is diminished significantly, yeah? When I raise an order for a trade, I'm not fearful of if I get a losing trade at all. It really is just a matter of going through the motions for me, and it should be for you as well. Once you understand it and really start to implement these strategies around risk, the fear of making a mistake or getting it wrong, it goes away, and it opens that freedom to be able to work within the market. And it comes with a level of acceptance. So when you accept that there is risk in trading, if you want to avoid risk, then don't trade. Simple. Don't do anything. There's risk in everything. As a matter of fact, the biggest risk in the world is not taking any risk at all. It'll bite you in the backside at some point, right? So you accept the risk. You can't avoid the risk. You reduce the risk. You manage the risk. And the whole idea of taking any risk in anything is the reward, is to transfer that risk into a reward. And that's exactly what trading is about. When you understand the mechanics of what it is that you're doing, it becomes much, much easier for you to understand how to do it too. Now, when it comes to risk management, the first thing that we need to understand is that we need to have an entry price and a stop loss at an absolute bare minimum. And for that, you need to have a strategy. And for that, this program is helping you to work out what it is that you need. If you want my strategies, join me at the Grow Me Go and I will give them to you. No problem at all. But this is giving you a heap of ingredients for you to start to nurture and build a strategy of your own if that's the way that you want to go about it. The tools that I'm teaching in this sequence, or in this series, are the tools that I use. When you have an entry price and you have a stop loss, now you've got predefined levels. Now you can work out the risk available to you and how many contracts that you're going to raise the order for. You can also then start to get a multiple of reward, because if the risk is between here and here and your reward is that, it's a 5-to-1 reward to risk ratio. You might want to take that trade. Once you've got those predefined levels of entry and stop loss, you can then start to manage that risk. Take that fear of how much you're going to lose. No more do you need to worry about liquidation prices. As a matter of fact, when I hear about people that say, I'm long in Ethereum with 10x leverage and my liquidation price is 2,800. It's like, so you're risking everything? You're just going to wait for the market to, like, for your account to just get margin called? Is that your strategy? It's a really poor way of doing things. It really is not a good option. It's so loose. It's so loose. You don't want to be doing that. You never want to get a margin call, and you should never get a margin call as long as you're managing your risk correctly. And again, that comes with peace of mind because you know what you're doing and you know how much you can afford to lose on any given trade. So, diving in a little bit deeper, we go from risk to reward. So your stop loss and entry will be your risk. It will also dictate the reward that you have available to you on any given trade. So trade risk versus reward is important, much more important than a win-loss ratio. But let's have a look at that now. Your account risk is going to decide how much you risk per trade. So let's say this, and let me just jump to the next one because it will tell you. All right, here we go. 1% of your account is what I suggest. It's what I do too, at a maximum. And what this means is, let's say that I've deposited into BloFin 10,000 USDT. And I'm trading off of 10,000 USDT. Well, if I'm risking 1% of my account, I'm risking $100. Now, that doesn't mean that, it's not the same as spot. If you're using leverage, you might be controlling a $3,000 position whilst only risking $100. It might be a $20,000 position whilst only risking $100. So don't look at the size of the position as a model of the dollar risk, as a size of the position and the potential reward that you can take. So 1% per trade means that you stick around for long enough to get it right and to not go through massive drawdowns or massive periods of despair, pain, hurt, emotional turmoil, frustration, all of these things. You can avoid those by simply managing your risk correctly. Now, for those of you that have been investing time and energy into markets for a little while now. You've probably heard of a dude called Paul Tudor Jones. And for those of you who haven't, he's one of the guys from the new, I think it's the Market Wizards books. There's Market Wizards and there's a New Market Wizards. I think he's in the New Market Wizards. Anyway, I've taken an excerpt out of this book because it's so crucially important. This is what he says. I'm always thinking about losing money as opposed to making money. Don't focus on making money. Focus on protecting what you have. Absolutely sums up exactly what trading is when it comes to risk principles. Keep what you've got. If you can keep what you've got and stay in the game, you will eventually see the returns come in. Whether it's immediate or down the track, you will get there. But if you don't manage your risk, you will not be around long enough to get to where you wish to be. Okay, it's really, really that simple. A $5,000 account, you're going to risk $50 per trade. Okay, the reason, well, it's twofold. You want to keep your head in check, so you don't want to be emotional, and losing $50 on a single trade doesn't really hurt you, but losing $500 on a $5,000 account really does, because it's a 10% loss. A calm mind makes much, much better decisions. Okay, keeping a calm mind, having a great routine, keeping an understanding of what it is that you're doing, not what the market's doing. What are you doing? How are you going to operate within this market at any given moment? Okay. And the second part is just to keep you in the game, keep you in the learning curve to make sure that you continue to grow as a trader. Now, there's a very simple thing for you to go ahead and move forward with here. Create a simple risk management plan. And this is something that you should probably read before you get into the market each day as you're beginning. It's very, very simple. Of course, I've put one line here so it can all fit onto one slide, but give it a little bit of detail for yourself and make it about you, because it is you who's managing your trading. So you want to put in what your trading capital is. Risk management is key, because not just because I don't want to lose all my money. Give it reason, give it some flair, some depth, put some rewards in there, okay? As you see at the bottom, put in your reward for accountability and sticking to a plan. Then you've got something to measure against. Now you've got a business. Now you're working towards something as opposed to just punting in the market. The maximum percentage risk I'm prepared to take on a trade is, and put 1% if that's what it is, and then give the reasons as to why. Again, a bit of depth, a bit of love, a bit of personal experience or personal, make it yours, you know what I mean? You also need to have a parachute plan, which is I will do a trading review if my account falls by, say, 2% in a day, 3% in a week, 4% a month, something like that, where you know that if you do hit a point where you go, oof, I've just hit my stop point, you go and review all of your trades. And of course, against the checklist, it means you can review your trades because you've got something to measure it against, hence another reason why I use checklists. What this does is it stops you from going into an emotional spiral. Now, I have revenge traded before, and I have lost my account because of it many, many years ago. Okay, revenge trading, when you go, if it can just get back to here, or you put a bigger trade position on because you just need it to get what you just lost back. That is revenge trading. And revenge trading is emotionally driven. It doesn't make any logical sense. And all you're doing is going on hope. You want your money back, so you're pushing it too hard. This will ultimately spiral to you losing your account or a big chunk of your account. It will never, ever, ever lead to a positive outcome, because even if you did hit that winner and you did get your money back, you're enforcing to yourself that taking bad decisions or making bad decisions comes with rewards. Again, this is not what you want to be doing if you want to be sticking around for the long term. So follow through with this risk management plan, work through this and combine that with everything else within this series. Subscribe on the channel now and you'll get more and more and more details to help you to become a better trader from me, who's been doing it for 20 years. Sign up for your BloFin account in the link below as well and share it with your mates. Have a great day, and I'll speak to you soon. Bye for now.